Well, the summer surge in consumer spending continues into the fall. September retail sales came in hot for the sixth month in a row, rising 0.7% on a monthly basis. With many sectors like e-commerce, food and auto seeing growth, popular gift-giving areas like apparel and electronics dipped. Our next guest says this doesn't bode well for the holiday shopping season. Let's bring in Deborah Weinswig, Coresight Research CEO. Good to have you, Deborah. So help us get the lay of the land here and how consumers are actually doing when you factor in how much they are spending on gas and auto sales and food and services.
What was really impressive was on the grocery side, where we saw a 2.5% increase in the month of September, and inflation is about 2.4, so actual unit increase. And then if we look on the restaurant side, where we saw an increase of 9.7%, and about a 6% increase in inflation, right? We're starting to see real kind of like unit increases. So I think that on the food side is quite interesting. On the home side, things have definitely been a bit weaker, whether it's furniture or building materials. So those are some of the areas where we are seeing weakness. And if we look across the board, the discretionary categories as a whole underperform those that were more staples oriented.
Yeah, what does that tell you about the calculation among consumers right now? I mean, obviously they are still facing higher costs when it comes to groceries, goods. We saw gas prices go up as well in the period, and yet they are still spending, but looking for those trade-offs.
And you bring up something very important is we are seeing consumers shop earlier this year, right? The holiday does come every year. What it looks like is different by year, but we are seeing people plan more than they have in the past. And so this idea that, as they move through kind of October, November, December, things may be a bit bumpier in the road, but they want to make sure that, they have the holiday that they want. So that's been quite interesting. I will tell you, in talking to executives at retailers, brands, CPGs, they are, I think, almost pinching themselves because things have continued to be stronger than expected. They are kind of waiting for that shoe to drop. But as of yet, it hasn't. I do think there is a watchful eye as it relates to gas prices, as was mentioned.
So then, as we wait for that other shoe to drop, we keep getting things like Amazon Prime Day earlier, multiple ones in the summer as well. How hard is it then to actually gauge where the holiday shopping season is going to go? Because it does start at so many different times now.
It's very hard, actually. And if you think about it, right, the holiday season really used to be kind of, Thanksgiving to Christmas. And then we had Black Friday and Cyber Monday, and now I think we have Secondhand Sunday. But it's also turned into kind of Black Friday week. And so that is very challenging to read. And, with the supply chain challenges that we faced back in 2020, things really started to move earlier. So it's fascinating to see that holiday is really now defined as like October, November, and December. So it's a 3-month period. And certainly there's this move back to traditionalism where consumers are trying to kind of remember their holidays pre-pandemic and recreate those. And with that, we're seeing spending, I think, in areas that are in some ways unexpected.
So with that said, Deborah, how aggressively are we likely to see retailers discount, given the pullback that we've seen in discretionary spending going into the holiday season?
Yeah, so our estimate is 3 to 3.5%, with basically minus inflation about 1 to 1.5%. If inflation comes in a little bit less, right, we'll see greater unit growth. I do think that many retailers have been conservative. We still do have retailers, though, who are cycling through inventory from holiday past. So things that we had never heard, well, we hadn't heard in at least a decade or decade and a half, which was this idea around pack away. So that's when retailers take this season's or last season's holiday merchandise, and it can be footwear, clothing, accessories, kind of decor, and they pack it away and then they bring it out this year and put it back on the shelves at full price. And so I think that there is this balance between kind of goods of Christmas past, if you will, and the current, kind of environment, and this balance of getting everything right. So I would say my fear is that we're still a little over inventoried. And that could be a challenge. And a lot of it is from that pack away merchandise. The other change we're starting to see is this idea around like fast luxury, which is, right, consumers who are, kind of very focused on this secondhand market. And, just a change in the dynamics around the holiday season and more of a move to like refurbished goods, right? Kind of the on the floor samples and whatnot. So the consumers still want to have the holiday they want to have. It's just a matter of how they get there. And so they're being more mindful. They're starting earlier. There's more planning involved. And, they're really kind of focusing on the discounts, but also thinking about different ways to buy the product that they want at the price they can afford.
Deborah, we're coming off the back
Deborah,
of big bank earnings that, we heard about consumers, racking up some of that debt. When you think about where they're likely to spend, I mean, does that point to more credit card debt come January?
Absolutely. And we are seeing also, too, on the mortgage side, unprecedented asks for loan modifications, right, in a higher interest rate environment. So I do think we are seeing, debt continuing to climb. And it goes back to, I think, this, people want to have the holiday that they want to have. And they are mindful in terms of how much they're racking up, with the idea that they can repay it in 24. But I still think that people are getting a little bit ahead of themselves, right? A year ago, we all had more savings. So I do think there is a betwixt in between. But, 2024, we'll have to think about how we're paying off what we spent in 23.
So, Deborah, with that in mind, with consumers, being more mindful and trading off, but also in terms of inventory, as you mentioned there, which retailers are perhaps better positioned than others to weather this sort of environment?
I mean, I think those that are platforms, and some of the companies I'm mentioning are ones you wouldn't think of, but right, Macy's is a platform, right? You've got Target and Walmart and some of these bigger retailers, but the other side of that as well is they also are driving revenues and really bottom line through something called retail media networks. So basically the brands and the vendors are paying to have a space on their digital shelf, and in some cases space on the physical shelf. So I do think that the retailers, right, because of this, retail media networks, I would say, while they're not new, the growth is really kind of exponential, so that retailers can afford to give bigger discounts. They can afford to, work with consumers in different ways in terms of paying off credit card debt, et cetera, because they have not only retail media networks monetizing their data and monetizing their IP. So that's the positive. So from a retail stock perspective, I think they're in great shape. And I think they're willing to work with consumers in a way that we haven't seen in years past, because of this additional set of funds that they have, coming in. And I think for themselves, coming in stronger than expected.
Well, time to get your holiday shopping. You got me thinking already there. Deborah Weinswig, Coresight Research CEO. It's good to talk to you today. Appreciate the time.
Thanks.